Here's the thing. The second you try to move a genuinely large amount of your own money, it stops feeling entirely yours. You send a wire, pay a contractor, close on a car, wire a down payment, move inheritance money between your own accounts. And instead of it just going through, the way every small transaction always has, you get a message. This transaction requires additional review. Your card freezes mid-swipe. Sometimes a call comes in from an unfamiliar number asking you to confirm it's really you. And every version of that message says roughly the same thing, for your protection. Reassuring words, except nobody ever explains what actually just happened, what a system somewhere decided about you in well under a second before a single dollar moved. So here's the real question, not the customer service version. What specifically triggers that freeze? What's the actual rule, the actual number, the line your transfer crossed? Because there is one. There are several, and they're not secret. They're federal law, written down with exact figures attached. Once you know them, a frozen transfer stops looking random. It starts looking like a machine, following very precise, very legal instructions, most of which have nothing to do with you personally at all. It's worth sitting with how strange that actually is. You didn't do anything wrong. You moved money you already had to a person or account you already knew. And somewhere between your bank and theirs, a system ran a version of a background check on the transaction itself, not on you, on the shape of the transfer, and decided it looked enough like a crime in progress to stop it. That's the part nobody says out loud when they say, for your protection. The protection isn't really about you, it's about the bank. Start with the number almost everyone's heard but never actually understood. $10,000. Move that much cash, an actual deposit or withdrawal, and your bank is legally required to file what's called a currency transaction report, a CTR, with the federal government. Not because you're suspected of anything, because the law says so, automatically, every single time, for every bank in the country. It comes from the Bank Secrecy Act, a law from 1970 built to make large movements of money traceable on paper, whether or not anyone at the bank thinks you've done anything wrong. Here's where it gets more interesting, though, because that $10,000 rule is the one people know, and it's almost never the one that actually freezes a transfer. Wires and electronic transfers don't work like cash. There's no CTR for a normal wire. What holds those up is a completely different, much quieter system, one that doesn't care about a single round number at all. It cares about pattern. Every bank of any real size runs continuous fraud detection models across every transaction that moves through it. Not a person reviewing your transfer. Software trained on the shape of what fraud usually looks like, scoring your transaction against your own history in real time. It looks at velocity, how fast money is moving compared to how you normally move it. It looks at whether the recipient is new. It looks at whether the amount is unusual for you specifically, not unusual in general. Someone who wires 4 figures every month for a business looks completely different to that model than someone whose account has never sent more than a few $100s suddenly sending $20,000. Same amount, wildly different risk score, because the model isn't reading the number, it's reading the deviation. Picture 2 people sending the exact same $20,000 wire on the exact same afternoon. One of them runs a small business and moves money like that most weeks. To the model, this is Tuesday. The other has never sent more than a few $100s to anyone, ever. And this transfer is going to a brand new recipient they've never paid before. Same dollar amount, same destination bank, same time of day. One sails through without a flicker. The other gets held, because relative to that specific account's own history, it's an outlier by every measure the model tracks at once: size, novelty of recipient, and how sharply it breaks from a normal week. The model was never given a rule that says $20,000 is suspicious. It was only ever given a rule that says suspicious is whatever doesn't look like this account specifically. And that's actually the first real answer to the question. Your transfer didn't get flagged because it was large. It got flagged because it didn't look like you. But here's the part that's actually clever. There's a second layer sitting underneath the fraud model. And this one isn't a business choice the bank made. It's the law again, a different law. Every bank has to watch for something called structuring, deliberately breaking a large transfer into smaller pieces specifically to duck the $10,000 reporting line. If the system sees several transfers just under that threshold, close together, it doesn't see coincidence. It sees a shape it was specifically built to catch. And when it sees that shape, real or not, actually structured or just an unlucky pattern of ordinary transactions, the bank has to act on it, often before a human ever reviews the case. That's genuinely one of the strangest parts of the whole system. Banks aren't just allowed to hold a suspicious transfer. They're legally required to. There's a form behind a meaningful share of these freezes called a Suspicious Activity Report, a SAR, filed with a Treasury Bureau called FinCEN, the Financial Crimes Enforcement Network. Banks file millions of these a year. And here's the detail almost nobody knows. It is against federal law for the bank to tell you a SAR was filed, not a policy, a law. Which means when a support agent says, "I can't tell you exactly why this is flagged," that isn't always a scripted brush-off. In a real, specific set of cases, they are legally forbidden from telling you the truth, even if they wanted to. And structuring itself carries a genuine sting most people never see coming. It's a separate federal crime, on its own, completely independent of whether the underlying money was earned legally. You can structure fully legitimate savings, money you paid tax on, money you're entirely entitled to move, and still be prosecuted for the structuring alone. Because the crime isn't having illegal money. The crime is trying to defeat the reporting requirement. Which means the well-meaning version of this, someone who's heard the $10,000 number and, trying to be considerate, deliberately keeps each transfer just under it, is doing the single most likely thing to get their account frozen and reported. The rule everyone thinks they're cleverly working around is the exact pattern the system was built to catch. There's a third system running in parallel to both of those, and it's the one that produces the most bizarre, most infuriating freezes, the ones where you've done absolutely nothing unusual at all. It's called OFAC screening, run by the Treasury's Office of Foreign Assets Control, and every transfer gets automatically checked against a list of sanctioned names and entities. The problem is the matching isn't exact. It's a similarity match, run at scale, across millions of transactions a day. Share a name, or even part of a name, with someone on that list, and your perfectly ordinary transfer can get pulled for manual review, purely on a coincidence of spelling. Not because of anything you did, because of who else happens to share your name. Send that same transfer across a border, and a fourth layer stacks on top of the other three. And this is where the delays get genuinely long. A domestic wire moves bank to bank. An international one moves through a chain of correspondent banks, intermediary institutions that hold accounts for each other, so money can hop between currencies and countries without every bank on earth needing a direct relationship. Every single link in that chain runs its own independent compliance screening. Your bank clears it. Then the correspondent bank clears it. Then, often, a second correspondent bank clears it before it ever reaches the receiving bank at all. Each one is legally exposed if it lets dirty money pass through. So each one rechecks the transaction from scratch, on its own timeline, using its own systems. And none of them are required to tell you where in that chain your money currently is. That's the real reason an international wire can vanish for days without a single person doing anything wrong. Layer all four together, and you can reconstruct in order what actually happens the moment you hit send on a large transfer. First, the real-time fraud model scores it against your own history for how unusual it looks. Second, if the pattern resembles structuring or a suspicious sequence, the anti-money laundering system flags it for a SAR review, which the bank is legally restricted from discussing with you. Third, independently of either of those, the transfer gets screened against the federal sanctions list, and a name similarity hit alone can pull it aside regardless of everything else checking out clean. Fourth, if it's crossing a border, every correspondent bank in the chain repeats a version of all of this on its own. Any one of those four can freeze your money. None of them require you to have done anything wrong. Here's the part that actually explains why banks are this aggressive about it, though. And it isn't civic duty, it's liability. Banking law puts real financial exposure on the bank, not you, when a transfer turns out to be fraud you didn't authorize. The exact rules differ depending on whether it moved as a wire or as an electronic transfer, but the shape is the same either way. If your account gets compromised and someone else moves your money out, the bank is generally on the hook to make you whole. Which means every dollar that leaves through fraud is a dollar that can come straight back out of the bank's own balance sheet. Freezing a transfer for review costs the bank an angry phone call. Not freezing it and being wrong can cost the bank real money. The incentive was never really about protecting you out of kindness. Under the actual rules, your fraud loss becomes their fraud loss, and stopping it before it happens is simply cheaper than paying it back after. Which is also why the fix, when you actually hit one of these freezes, is almost always faster and simpler than it feels in the moment. A live phone call, one that confirms you're really the one who initiated the transfer and that it's going where you meant it to go, resolves the overwhelming majority of these holds the same day. For international wires stuck in the correspondent chain, the honest answer is less satisfying. You often just wait, because no single bank in that chain owes you a timeline. But in the domestic case, the one most people actually hit, the system isn't trying to keep your money. It's trying to get one specific piece of information it's structurally not allowed to just assume, that the person hitting send is actually you. There's a genuinely practical move buried in all of this, and it's one almost nobody thinks to make ahead of time. Because the fraud model is scoring your transfer against your own history, the single biggest thing you can do to avoid getting flagged is give it history to compare against before you need it. Call your bank in advance of a large, out-of-pattern transfer and simply tell them it's coming. A short conversation now, days before you close on a house or wire a deposit, does the exact same job as the verification call you'd otherwise get afterward, except it happens on your schedule instead of interrupting the transaction itself. Banks will not tell you this proactively because there's no incentive for them to. A smoother transfer isn't their problem to solve until it's already stuck. And that's the twist underneath all of it. The freeze that feels the most personal, the one that makes you feel surveilled, suspected, singled out, is almost every time the least personal thing your bank does all year. It's not a person deciding anything about your character. It's 3 or 4 separate, mostly automated systems, built off separate federal rules, each one just doing the narrow job it was legally built to do, running silently underneath every transfer you've ever sent, without you noticing, until the one time the pattern lines up wrong, and you finally see the machinery underneath. So the next time it happens, and for anyone who moves real money regularly, it eventually will, you'll know exactly what's actually going on behind "for your protection." It's not one rule, it's 3 or 4 stacked, mostly invisible, and none of them are about you specifically, right up until the math briefly makes it look like they are. If you've ever paid off a loan completely, in full, on purpose, and then watched your credit score drop right afterward, as a reward somehow for doing the responsible thing, that one's next. And the reason is even stranger than this one.